So we're going to start by talking about what mutual funds are. I hope everybody can hear me clearly. So a mutual fund is a type of financial vehicle that's made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments. So basically, different investors, people come together, pool funds together, and then invest in mutual funds. So it is a vehicle that gives you access to other securities like stocks, bonds, and money market instruments. Mutual funds are typically managed by a fund manager who allocates the fund assets and attempt to produce capital gains and incomes for the fund's investors. So with a mutual fund, a mutual fund is not an instrument of itself. It's only a vehicle that gives you access to different kinds of mutual funds. And there are different types of mutual funds. You can have mutual funds that have the underlying assets as stocks, or you have mutual funds that have their underlying assets as bonds, or mutual funds whose underlying assets, money market instruments, or really any type of instrument. Some of them are even mixed. So you could have a mutual fund that invests a little of its cash in bonds and stocks, and mixes like that happen. Usually there is a prospectus that guides the fund manager. Like I said before, the fund manager is a person who manages the fund essentially. So he has a guide, like a guiding principle that would advise him on the kind of stuff that he can do with the mutual fund, and it's usually called the prospectus or trust deed, as whatever term you decide to call it. So a few more things that you should know about mutual fund is that when you buy a unit or a share of a mutual fund, you're buying into the performance of the fund and part of the portfolio's value. Because remember that the mutual fund is not just you, right? It's a group of people, a number of people that come together to invest in this security. So you're buying a unit of the mutual fund. So you're buying into the total portfolio of the fund. A portion of it now belongs to you. So it's like, let me liken it to what they call ajo, like group investment. You and your friends come together that, oh, let's bring money together and invest in something. That's what it is. So a part of the fund's value belongs to you. The value of the mutual fund also depends on the performance of the securities it's investing. So like I said before that, a mutual fund is just a vehicle in itself. It's not a security, right? So there are instruments or securities. Pardon me, I'll use those terms interchangeably. They mean the same thing, instruments, securities. There are instruments or securities that the mutual fund invests in. So like I said, you could have a mutual fund where it's underlying assets. Underlying assets meaning the securities that the mutual fund is investing in. So you can have a mutual fund where the underlying asset is stocks or is bonds or is money market. So for example, if it's a stock, the performance of the mutual fund is basically going to be how the stocks in the portfolio perform. So if it's a stock mutual fund, for example, you could have a mixture of let's say the portfolio investing, let's say GT Bank, Nigerian breweries, and other stocks like that. The performance of the mutual fund is dependent on the performance of those stocks in the portfolio. Hope you're following what I'm saying. Like I said earlier, there's going to be a question and answer session. So you could just leave your questions, and then when we're done with all of this, we would answer all your questions. So mutual funds also, they pool funds from investing public, and then they use the money to buy securities. Like I said before, is a number of people coming together, pulling funds together to invest in securities that otherwise they may not necessarily be able to access on their own. So with a mutual fund, you're better off in a mutual fund than sometimes going to the market on your own, because it gives you access to a wide variety of instruments. Like I said before, there are different securities that are within the portfolio of the mutual fund. So the same amount of money you could use to invest in a good number of stocks, you probably won't be able to use that same amount to invest if you had to go directly into the market to purchase those stocks on your own. Hope everybody's understanding. So investing in a share of a mutual fund is different from investing in shares of a stock. Like what I said earlier, when you invest in a GT Bank stock, for example, you own part of GT Bank. But then if you're investing in a mutual fund, you do not own the stock directly, you own a part of the mutual fund. So you can't go to GT and say that, oh, because I have shares in this mutual fund, it means that I have shares in GT Bank. No, that's not how it works. And then also you don't have voting rights, because for stocks particularly, they usually have their AGM and stuff where shareholders can come and make some decisions on what the company should be. But if you're invested in a mutual fund, you don't have that right to make those kind of decisions. You already have the fund manager who is making investment decisions on your behalf, and he's being guided by the prospectus. So you trust that he will make decisions that are in your best interest. Then how can you earn, or how is money earned on mutual funds? How can you earn interest or dividends on your mutual fund investment? So there are typically 3 ways that you can earn income on your mutual fund investment. So firstly, income is earned from dividends on stocks, interest on bonds. And that dividend from stocks and interest from, they mean the same thing, dividends, interest. It's just terms that they use in the capital market. So income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. So meaning that when the portfolio of a mutual fund, you earn dividends on them. So for example, if it's a stock portfolio, you know that periodically you're going to earn dividend on those portfolios. So it's the interest that is gained, or the dividend that is gained, that is now distributed across all the investors who are invested in the mutual fund. And then some investors can decide that, okay, with my earnings, I want to purchase more shares of the mutual fund. And some people may decide, okay, I'm just going to bank my profit. I want my whatever I've earned so far transferred to me so that I can do whatever I please with it. While some will be like, okay, let me reinvest this my profit, and then so I can have access to more shares of the mutual fund. Another way is that if the fund sells securities that have increased in price, the fund has capital gains, and then most fund managers will pass these gains down to the investors. So for example, can you all still hear me?
You were not audible for a while.
I hope you all can still hear me and can see my screen.
Yes, we can hear you.
I need you to help me.
We can hear you.
Confirm if everybody can still hear me.
Now we can.
Okay.
And the screen is here.
Okay, that's good. So as I was saying, usually securities generally have prices. Usually they are priced. So for a bond mutual fund, a mutual fund that has assets, online assets as bonds, for example, or even stock, you could purchase a stock for, let's say, 50 naira, for example, and then over a period, based on the principles that apply in the market, the value of this stock has appreciated to 60 naira. So it means that you made 10 naira in gains. So the fund manager can decide that, okay, I'm going to sell the security since I've already made a gain of 10 naira. I'm going to sell the security, and then that 10 naira is then distributed across all the investors in the mutual, that invest in the mutual fund. So you see that that's what they call capital appreciation, or capital gains rather. Capital gains. So that profit is distributed across all the investors. That's another way that profit is earned, or money is earned on mutual funds. And then lastly, if the fund holdings increase in price but are not sold by the fund manager, the fund shares, you can then decide to sell the mutual fund shares for profit, because a lot of mutual funds, or most mutual funds, are priced. So meaning that if you're buying a mutual fund now, they can tell you it's the price of the mutual fund is 10 naira per unit. It means that you probably entered at 10 naira, and then because of performance of the fund, the price of the fund is appreciating, and then you wake up one day and see that, oh, it's no longer 10 naira per unit, it's now 15 naira per unit. So you as an investor, you can decide that, okay, I made already 5 naira in profit, so I want to sell my units and then bank my profit. So that's another way that you can make money from your mutual fund investment. So it's always advised that you should keep track. Anyway, a lot of fund managers make that available for investors to keep track of their investments and the performance of the investment. That's one of the advantages of investing in mutual fund, because it's very transparent. The operations are very transparent for everyone to see. So these are some reasons why I should invest in a mutual fund, or reasons why you should invest generally in a mutual fund. First, for diversification. Like I said earlier, if I had, let's say I had 500K and I wanted to buy shares of a company, what I would be able to purchase will not be as profitable, or will not be as the amount of units I'll be able to purchase will not be as good as what I would if I were in a mutual fund, or if I invested that 500K in a mutual fund. Because when you invest in a mutual fund, it gives you access to a wide variety, or a wider variety of instruments, rather than if you had gone on your own. And then there are some instruments or securities that you want to purchase, and then the minimum investment amount is so high. But then if you invested in a mutual fund, it would be lower. So mutual funds they give you less for more. They give you more value for less amount of money. So, and then you're exposed to a wide variety of instruments. So that's diversification, because it gives you access to a good number of things. And then there's transparency. Like I said before, the operations of a mutual fund are usually very transparent, because first of all, you have the trust deed that already guides the fund manager on its operations, what it can do with fund and what it cannot do with the fund. So usually the trust deed makes sure that, okay, the fund manager is investing in kind of instruments that usually will not pose as much risk. They try to mitigate the risk as much as possible. They have like clear-cut boundaries and thresholds of the kind of stuff that you can do. And then it's not just the fund manager that is involved in the entire process. There are other parties that are involved in a mutual fund that also makes mutual fund as transparent as they are, so you can clearly see what is going on. And then there's easy access. Investing in a mutual fund would not cost you much hassle. It's pretty easy. All you need to do, for most fund managers, what you usually need to do is just fill out a form, provide them with your normal documents that you would provide to your banker if you had to open an account, basically. So you provide them with that information, and that's it. It's usually one-off, except maybe you have to update your documents at some point, but it's usually a one-off thing, and then you can easily invest and redeem as often as you like. It's really easy, honestly. It's very flexible. It's very flexible, because you can decide, okay, I want to invest on a weekly basis, on a monthly basis. It gives you that kind of flexibility. And then also you can decide that, oh, I need funds and then I want to redeem my funds. So it gives you that kind of easy access. And it's also very liquidity, meaning that when you need cash, you can easily get your cash back. Your funds are not tied up per se. They're not tied up for so long that, I have money somewhere, but I don't have access to it. Mutual funds are generally not like that. They are very liquid. You have easy access to them. And then they are professionally managed. So you have people who, that's what they are paid to do. They are paid to manage these funds on your behalf and make the best decisions for you. So you can be rest assured that whatever it is, your risk is way more mitigated if you're in a mutual fund than if you were on your own, as an investor on your own in the capital market. Because if you were stocks, for example, you can be rest assured that your investment, your fund manager is doing the best that he can to make sure that your risk in that asset type or asset class is mitigated as much as possible. They are looking for the best yielding instruments out there for you. They have their eyes on the mutual fund 24/7, just to make sure that they are giving you the best returns out there. So like I said before, aside from the fund manager, there are other parties to the fund. We have the trustees, the custodian, the fund manager, like I've been saying, and then the registrar. So the trustee, basically, his role is to ensure that funds are actively managed in the interest of the investor. Like I said, there's mutual funds have the prospectus or the trustee that guides their action. So the trustee is basically to ensure that the fund managers are not contravening trust deed in any way. So it means that it's kind of is like the fund manager is answerable to the trustee, because periodically they would have to report to them and show them that, okay, this is how the fund is, this is what we have done so far. And then the trustee would make sure that, okay, this is actually in line with what the prospectus says or what the trust deed says. And then you have the custodian. The custodian is usually appointed by the mutual fund company, and then they hold custody of the securities and assets in the fund. The custodian is usually a bank or a financial institution that's been approved by the SEC. So what they do is that they keep stock, or they hold the assets and securities of the mutual fund in their position, meaning that as an investor, the money that you've paid is not going to the fund manager per se. It's going to be held on your behalf with the custodian, same as the securities that are bought for that mutual fund. They are held by the custodian. So usually the benefit of this is that, aside from the fact that the fund manager doesn't have access to do as he pleases with the funds or assets of the mutual fund, if, for example, the fund manager goes bankrupt, for example, the custodian has your funds, right? So you can always go back to them with your evidence of investment and tell them that, okay, I have so and so units of shares in this mutual fund, and I want to claim it, and then they should be able to provide you with your funds back. Like I've talked about the fund manager, they basically manage the funds and everything about the mutual fund, and then you have the registrar. So the registrars, they basically hold record. They keep record of the investors. They keep record of unit holdings that belong to each investor. They also issue certificates, and they can cancel certificates depending. They are basically the record keepers to make sure that you are who you say you are. So if you want to, let's say, redeem some of your funds, for example, is the registrar that will verify that this person is actually who they say they are. And then they have record of all your information. They have records of number of units you have and stuff. So they keep proper records of all the applicants and monies that come into the mutual fund. Yes. So what are the key takeaways from this? Personally, I have one of the advantages or reasons why I prefer a mutual fund to most other funds is because of consistency. So with a mutual fund, because of how easy and flexible it is, you can always decide that okay, I want to, maybe if you're a salary earner, you earn your salary every month, you can decide, okay, I'll set up a direct debit mandate with my bank that on so and so date, as soon as money enters my account, I want a particular amount of it debited into the mutual fund. So it's that easy, it's that flexible. And then I believe that as every individual should be accountable to themselves financially. So you should have savings or money that you're keeping away for the rainy day. So a mutual fund makes it easy for you to accomplish that because it's so easy to invest in. Like you can always just put your money, you can have a direct debit, you can set a limit for yourself that, okay, if it's on a weekly basis, on a monthly basis, on a quarterly basis, I'm going to be putting some of my funds there. So the key takeaways from this is that a mutual fund is the type of investment vehicle that consists of portfolio stocks and other securities. They usually give you access to a diversified portfolio, and then you have access to different kinds of securities. So right now, we'll be taking questions. I have spent quite a bit of time going through the slides. So right now, I'm ready to answer your questions, look at your comments if you have any. Eli, if you can assist me, please, with the questions so that I can answer.
The first question is from Adedamola Dedeji. And his question
give
is,
me a
do we
minute,
determine what
I'm trying to get access to the questions that you might have asked. Okay, so a question from Adedamola. Do we determine what type of funds that the investment manager should invest in? Do we determine what type? Okay, he's basically asking if the investors can determine what type of funds the fund manager can invest in. So Adedamola, you can't determine the type of funds or instruments that the fund manager is investing in because it's already stipulated in the trust deed. So before you go into any mutual fund or before you invest in any mutual fund, you should know beforehand what the underlying securities of the mutual fund is going to be. So you can ask your fund manager for the trust deed or the prospectus that you like to have a copy of the trust deed, so you can go through it and see what kind of securities they are going to be investing in. And usually, before you invest, your fund manager will tell you what kind of mutual fund it is, whether it's a money market fund or if it's a bond fund or if it's a stock portfolio. So you are informed, but you cannot determine as an investor what kind of instruments you invest in. So Chris is asking that how do you determine the unit price of each fund held by the investing public? The fund manager usually provide you with that information. So at every point, usually it's daily, they can tell you the price per unit of the mutual fund on a daily basis, usually. what is the minimum you can invest? The minimum investment, this is by Adekunle. The minimum investment amount is based on the mutual fund, because you have mutual funds that they have a minimum of 5,000 naira. You have those that their minimum is like 1,000 naira. So it's depending on the fund manager and how the fund is structured. That's what will determine the minimum investment amount. Some mutual funds have a minimum of 50,000. Some have a minimum of 200K. So it really depends on the structure of the fund. So Omola is asking, what is the process of investing in mutual funds with the Afrinvest app? So on the Afrinvest app, the mutual funds are not listed. But then if you would like to invest in any of the mutual funds on there, you can send us an email at aaml@afrinvest.com. I'll take it again, aaml@afrinvest.com. After this presentation, an article on this presentation rather will be sent to all the everybody who registered, and then to have our contact information. Also, you can on this slide you can see below an email address also that you can refer to, info@afrinvest.com, or you can just text us directly at aaml@afrinvest.com. Adedamola is asking, for mutual funds, is it a monthly payment or a one-off? No, it's not a one-off payment. It depends on you. The frequency really depends on you. For most mutual funds, you can decide that you want to be paying in money on a monthly basis, on a weekly basis, on a quarterly basis, or annual basis. It really depends on how often you would like to be investing. And Ogale is asking, how easy is it to exit mutual funds, and what are the associated costs for exiting? For mutual funds, is it a monthly payment? Okay, no, so like I already answered, it's not a one-off payment. It depends, the frequency depends on you. How easy is it to exit a mutual fund? It's pretty easy. For most mutual fund companies, all you need to do is send them your request. They would sometimes require you to fill out a form, some don't require you to fill out a form. You could send an email instruction, or you could do it right from their web platform or whatever. So you can that's how easy it is to exit the mutual fund. And then associated costs for exiting. There are no costs for exiting. The only cost per se may be transaction charge, so meaning bank to bank, because they have to transfer the funds from your account or from your mutual fund account to your bank account, and that's a bank charge. So it's not necessarily the company or the mutual fund that's charging you. So there are no costs associated with exiting. So Dogara is asking, when you say highly flexible, is it as flexible as walking into a banking hall and withdraw my money if I want to withdraw my money? So you cannot just walk into the fund management company and ask to withdraw your money like that, because like I told you, there are other parties to the mutual fund, right? So you have the registrar, for example, who has to vet that the information you're providing is actually accurate. So you may have to give them some time. So usually 24 hours, 2 days, 3 days, that's what it takes for most mutual fund companies to honor your requests. So some take 24 hours, some take 2 days, some take 3 days. But it's usually fast. But it's not automatic. Let me say that it's not automatic, but a day, 2 days, 3 days will do. So Jaminu is asking, can you explain further, I'm guessing, on type of investment, on type of investments? So Jaminu, that would take us off course for me to explain on different types of investment, but you can send us an email and then we'll answer your questions. And also, this is just one of a series of webinars that we'll be having. So I'm sure that going forward, a colleague of mine will touch on the type of investments that there are. So we're going to be having this series on a weekly basis. So we'll keep you informed as to when the next webinar will be holding, and then you can listen in, and then I guess your question we're asking, or you can just send us an email and we'll answer your question. So if he's asking, what are the penalties associated for terminating your investment prematurely? So for some mutual funds, they would insist that you keep in your funds for maybe a period of 30 days or 90 days, depending. And that's basically because they want you to have left your money in there for enough time to have accrued a substantial amount of interest. And then there will usually be a pre-termination charge. So sometimes it's depending on the company, actually. The company is who determines penalty fee or what interest it's going to be. For us, usually we charge 20% of the interest accrued. But even right now, we're not charging any penalties because we understand situation of things in the country. So right now, there are no charges. But typically, it's a company that determines what the penalty fee would be. Gemini is asking that at the difference between each package. So there are different types of mutual funds, right? And they have their different underlying assets. So Jamino, I think you should send us an email. Like I said, our email address is aaml@afrinvest.com, and we would answer all your questions regarding what investment securities are and the type of investment packages that are available. So Adekunle is asking me to give random examples of possible returns. So the returns on mutual funds vary. First of all, depending on the kind of assets that the mutual fund is investing in, and secondly, depending on capital markets dynamics. So there are sometimes that a money market mutual fund would typically be regarded as the safest type of investment or safest type of mutual fund, because they are usually low risk and they invest in low risk instruments. So sometimes it can be as high as 10%, 15%. Sometimes it can be as low as 5%. So it really depends on market dynamics, and then also the type of assets that the fund is investing in. So I don't think that we have enough time to take more questions. It's already 12:32. So I will take this last question, and I guess that will be it. From Mayowa, when I see mutual funds, there are usually some rates besides, and it states low risk, high risk. Can you explain what it means? Okay, so like I said, mutual funds have different assets, different underlying assets. So for a stock mutual fund, for example, it's going to be categorized as high risk because generally stocks are very volatile type of securities. So a mutual fund that invests in stocks is going to be classified as high risk. Or if you're investing in a money market mutual fund, for example, it's going to be a low risk type of investment. So that's what the classification means usually. Like for Afrinvest now, we have a wide range of mutual funds. We have a stock mutual fund, we have a bond mutual fund, we have a money market mutual fund, and a dollar mutual fund. So our stock mutual fund, of course, is going to be classed as high risk. But then the risk is mitigated in the mutual fund than if you had to go directly to the market. We have a bond mutual fund as well. It's called NIDF. We have a money market mutual fund, which is low risk, very low risk type of investment. And then we have a dollar denominated mutual fund. Yes, you can earn money in a different currency as well. So I'm guessing those are all the questions. So we would send you the presentation, and then you can reach out to us on am@afrinvest.com. Here we have our branches, so feel free to ask us any questions and we'll get back to you. Thank you very much for listening, and please keep looking out for our other series because they would help you in learning more about investments and how the capital market works. Thank you very much. Have a nice day.
Thank you.